What if XRP isn't doing what people think right now? Because the debate over the US dollar's reserve currency status is moving into a much bigger question. What actually connects the world's currencies if the system becomes more multipolar? In the next few minutes, we'll connect the reserve currency debate, Ripple's bridge asset strategy, stablecoins, CBDCs, and the institutional thinking around digital settlement, and separate what's documented from what's speculation. Start with the dollar itself. For decades, reserve currency status has been treated almost entirely as an American advantage. But J.D. Vance has publicly argued that there's another side. A dominant dollar can make imports cheaper for American consumers while making American manufacturing and exports less competitive. That creates a much bigger question. If the United States remains a major financial power, but the global economy becomes increasingly multipolar, does the world still need one currency sitting at the center of everything? And if the answer is no, then the real opportunity may not be replacing the dollar. It may be building the infrastructure that allows dollars, euros, yuan, CBDCs, stablecoins, and other forms of value to move between one another. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the market. Thank you always to everyone who likes and shares each of our videos. These two things really do help out the channel. The reserve currency dilemma. Think about the current system. A European company has euros. An Asian company has yen. A Middle Eastern company has another currency. An American company has dollars. And when money moves internationally, the system needs liquidity, settlement, trust, market depth, and a way to efficiently exchange one form of value for another. The dollar has historically played an enormous role in that process, but there is an inherent contradiction. The more the world wants dollars as reserves, the more international demand exists for dollar-denominated assets. That can help finance the United States. It can help make borrowing cheaper than it otherwise might be. It can support consumption, but it can also contribute to an environment where financial activity becomes more attractive relative to manufacturing. This is not an argument that the reserve currency is the sole reason American manufacturing declined. That would be far too simplistic. Technology mattered. Globalization mattered. Trade policy mattered. Productivity mattered. China's industrial expansion mattered. Corporate decisions mattered. But the reserve currency structure can be part of the larger equation. And Vance's argument is essentially that America should ask whether the benefits are still worth the structural costs. The Federal Reserve officials have historically emphasized the advantage of reserve status, including the global demand for the dollar and dollar assets and the credibility generated by U.S. institutions and monetary stability. Powell also acknowledged that economists debate potential burdens associated with reserve currency status. So this isn't simply a crypto argument. It's a macroeconomic debate, and that distinction matters. To understand where this could go, we need to go and look backwards. Our first historical example is a transition from the British pound to the US dollar. For much of the 19th century, Britain occupied a central position in global finance and trade. London was a major financial hub. Sterling was deeply embedded in international commerce. But the 20th century changed the economic balance. The United States emerged as the world's dominant industrial and financial power. And after the Second World War, the Bretton Woods system institutionalized the dollar's central role in global finance. The important lesson isn't simply that one reserve currency replaced another. The deeper lesson is that monetary systems change when the underlying economic structure changes. The currency follows the architecture. The architecture follows trade, capital, institution, security, and economic power. Let this sink in, ladies and gentlemen. Write this down. That's very important. And that brings us directly into the modern era. Because today's world is not the world of 1945. Economic power is more distributed. The United States remains extraordinarily powerful. China is enormously important. Europe remains a major economic bloc. India is rising. Japan remains a major capital market. And numerous regional powers have significant economic influence. So perhaps the future doesn't require one country to inherit the entire monetary throne. Perhaps the future is different. The multipolar possibility. This is where Lynn Aiden's framework becomes particularly interesting. The argument is that the 19th and 20th centuries may have been unusual because global economic power was unusually concentrated. Britain first, America later. But what happens when economic power becomes distributed across several major blocs? The obvious answer is to assume that China takes the dollar's place. But there are enormous obstacles to this. China's currency remains subject to capital controls. The financial system is different from America's. The euro has its own structural limitations, including the absence of a fully unified fiscal authority across the monetary union. That's really important. Write that down. I go over this all the time with clients. They forget that. So the future may not be dollar yuan. It could be dollar plus euro plus yuan plus yen plus rupee plus others, a multipolar system. This creates a very specific problem. How do you efficiently move value between all those monetary systems? That's the infrastructure question. And this is where XRP, the anointed one, becomes relevant. Not necessarily as the world's reserve currency, not necessarily as the replacement for the dollar, but potentially as a neutral bridge asset. Now, this is what most people miss. There's a huge difference between being the world's reserve currency and being the world's bridge currency. Imagine the global financial system as a railroad network. The United States built one of the most important railroad stations. The dollar became one of the dominant tracks. For decades, enormous amounts of global economic activity passed through it. But now imagine the world adding hundreds of new stations, more currencies, more CBDCs, more stablecoins, more tokenized assets, more regional settlement systems. The problem isn't necessarily that the old station disappears. The problem is interoperability. How do you connect everything? That is the role a bridge asset could potentially play. And this is precisely the category in which Ripple has positioned XRP, the anointed one. See, Ripple's early OpenCoin project described the system as a way to facilitate transactions across different currencies. In 2013, OpenCoin said Ripple was designed to allow users to trade money in different currencies, with XRP surging as the native digital asset. That is an important historical detail. Write that down. Because the idea wasn't invented yesterday. The architecture was being discussed more than a decade ago. And that leads to the part of this story that gets much more controversial. Peter Thiel, the Peter Thiel connection. Peter Thiel is one of the most influential technology investors of the modern era. He co-founded PayPal. He founded Founders Fund. And he has backed companies across technology, defense, fintech, and crypto. There is rumors in the rumor mill that Peter Thiel personally backed OpenCoin and that he introduced Brad Garlinghouse to crypto. This is in the rumor mill, ladies and gentlemen. We need to be careful here. There is also documented evidence that the Founders Fund angel vehicle FF Angel 4 participated in OpenCoin's 2013 funding round alongside Anderson, Horowitz, Lightspeed, Vast Ventures, and others. So there is a real Thiel Founders Fund connection to the early OpenCoin ecosystem. But we should not turn that documented investment into proof of a secret geopolitical master plan, ladies and gentlemen. That leap isn't supported by the evidence. And this is where reasonable analysis matters, because there are two separate questions. Question one, did people around Thiel invest in early Ripple infrastructure? Yes, there is historical evidence for that. Question two, does that prove Thiel, Vance, and Ripple are coordinating a plan to replace the dollar with XRP? No. There is no evidence sufficient to establish that. But here's the fascinating part. You don't actually need a conspiracy for the thesis to become interesting. You only need people independently responding to the same structural problem. Thiel's old vision and Thiel's own historical thinking makes the subject even more intriguing. Again, this is rumor mill, ladies and gentlemen. In 1990s, Stanford, it's rumored that Thiel discussed the possibility of private money and financial instruments becoming increasingly important in a digital economy. Again, rumor mill. The broader concept was that technology could reduce the transaction costs involved in exchanging value. That's a very different monetary philosophy from the traditional model. Instead of everything ultimately passing through a government-issued medium of exchange, financial instruments themselves could become increasingly liquid and transferable. You could think of it as moving from money as the universal intermediary towards interoperable digital assets representing different forms of value. That sounds abstract, but look at what is happening today. Stablecoins represent dollars on-chain. Tokenized securities represent financial assets on-chain. CBDC experiments represent national currencies digitally. And blockchain networks provide programmable settlement. So suddenly, Question isn't, will crypto replace money? No. The more interesting question becomes, what happens when money itself becomes programmable? I want to hear in your comments. What do you think? And once you ask that question, interoperability becomes absolutely critical because a digital euro doesn't automatically know how to speak to a digital dollar. A digital yen doesn't automatically settle against a tokenized treasury. A stablecoin doesn't automatically solve global liquidity fragmentation. Something has to connect these systems. Our second historical example is Bretton Woods. In 1994, the Allied powers created a new international monetary framework. The dollar sat at the center, but the system wasn't created in isolation. It reflected the economic reality of the time. The United States has emerged from the Second World War with enormous industrial capacity, financial power, and gold reserves. The architecture matched the distribution of power. But systems built around one dominant power eventually encounter a different environment when global power becomes more distributed. That doesn't mean Bretton Woods was a mistake. It means monetary systems are institutional responses to economic realities. And today's reality is dramatically more digital. Imagine the next generation of global finance. Central banks issue digital currencies. Banks issue regulated stablecoins. Corporations tokenize assets. Financial institutions settle securities on distributed ledgers. AI agents initiate transactions automatically. And billions of dollars move globally without waiting for a traditional banking hours. It's a revolutionary idea when you see this happening and taking place. Suddenly, the infrastructure connecting those systems becomes almost as important as the currencies themselves. But the real shift came when blockchain stopped being just about cryptocurrency and started becoming financial infrastructure. See, that distinction is critical, the Kevin Walsh connection. And now we get to perhaps the most interesting documented piece of the entire story. Kevin Walsh is no longer merely a former Federal Reserve governor. As of 2026, he's the chairman of the Federal Reserve. The Federal Reserve's own records confirm Walsh became chairman in May 2026. Walsh co-authored a 2022 publication examining digital currencies and the future monetary system. The document discussed a hypothetical system involving an SDR-based stablecoin that could interact with national currencies. And critically, the discussion referenced Ripple's XRP-based cross-border payment system as an example of how such an architecture could resemble a bridge mechanism. Now stop for a second. That does not mean the Federal Reserve has endorsed XRP. It does not mean Walsh is planning to make XRP a reserve asset. It does not mean the U.S. government has selected XRP. Those claims would go far beyond the evidence. But it does mean something important. The concept of a digital bridge between national currencies was serious enough to appear in a paper co-authored by someone who is now leading the Federal Reserve. That deserves attention because it means the idea isn't confined to crypto Twitter. Here's the second historical analogy. Think about the early internet. In the beginning, different computers and networks existed in isolation. The breakthrough wasn't simply building another computer. It was creating protocols that allowed different systems to communicate. That is essentially the interoperability problem facing digital finance. You don't necessarily need one digital currency to replace every other currency. You need protocols and assets capable of moving information and value between systems. That could mean stablecoins. It could mean tokenized deposits. It could mean centralized bank infrastructure. It could mean traditional correspondent banking. It could mean several technologies simultaneously. And XRP is one candidate within the broader architecture. Ripple itself has continued developing infrastructure around cross-border payments, tokenized assets, and digital currencies, including working with central banks and governments. For example, Palo launched a limited US dollar-backed stablecoin pilot on the XRP Ledger with Ripple's CBDC platform in 2023. That is not proof of global adoption, but it demonstrates the direction, the bigger XRP thesis. So let's put everything together. There are actually several different XRP theses. The weakest thesis is XRP will replace the US dollar. That's an enormous claim. There is no evidence that this is an official US policy objective. A stronger thesis is XRP could become a global use bridge asset between different currencies. That is much more consistent with Ripple's historical positioning. And an even broader thesis is XRP could become part of an interoperable digital financial system where stablecoins, CBDCs, and tokenized assets move across borders. That is the really interesting possibility. Because XRP doesn't need to become the world's reserve currency for this thesis to matter. It doesn't need to replace the dollar. It doesn't even need to replace stablecoins. It could potentially sit between them. Think about a world with 150 or 180 digital different currencies. Each jurisdiction has its own monetary system. Each bank has its own settlement infrastructure. Each stablecoin has its own liquidity. The number of possible currency pairs explode. You don't necessarily want to build a direct market between every single pair. You can create hubs, and bridge assets can potentially reduce that complexity. That's the concept Ripple has been pursuing. And that's why XRP is interesting from an infrastructure perspective. What most people get wrong. But here's the part I really want you to understand. There's a massive difference between a good technological thesis and guaranteed outcome and adoption. XRP could fail to become a major bridge asset. Governments could prefer direct CBDC interoperability. Banks could use tokenized deposits. Stablecoins could dominate. Central banks could build their own settlement networks. Another blockchain could become the preferred infrastructure, or the financial system could remain much more fragmented than expected. All those outcomes are possible. And that is why we have to separate short-term noise from long-term structure. Price can move because of liquidity. Price can move because of regulation. Price can move because of speculation. Price can move because of leverage. None of those things automatically tell you what the financial system will look like 10 years from now. Prices reacting, systems evolving. That's the distinction. What the dollar debate really means. So does this mean the dollar is dying? No. That is the wrong conclusion. The United States still has extraordinary financial depth. The dollar remains deeply embedded in global trade and finance. And the Federal Reserve itself continues to emphasize the advantages associated with dollar centrality. The more interesting possibility is that the monetary system becomes layered. The dollar remains dominant, but stablecoins digitize dollars. CBDCs digitize other currencies. Tokenization digitizes financial assets. And bridge infrastructure allows liquidity to move between them. In that world, XRP doesn't have to defeat the dollar. It potentially helps the dollar participate in a more interoperable digital system. And that is a completely different investment thesis. Here's the convergence. Now look at the people involved. J.D. Vance has publicly questioned the economic course of reserve currency status. Peter Thiel has a long history of challenging conventional monetary and technological assumptions, while Founders Fund's early-stage vehicle participated in OpenCoin's 2013 funding round. Ripple built infrastructure around moving value across currencies. Kevin Walsh co-authored a paper that explicitly discussed the potential digital bridge architecture resembling Ripple's XRP-based cross-border system. And these pieces secretly coordinated. Are they? We don't know. There is no evidence that allows us to say that confidently. None whatsoever. But here's what we can say. They're all touching the same structural question. How does money move in a world where there is no longer one overwhelmingly dominant economic center? That is the real story. Not XRP replaces the dollar. Not China kills the dollar. Not the Fed secretly wants XRP. The real story is interoperability. And perhaps that is the biggest opportunity hiding in this entire debate. The future monetary system may not be about one currency winning. It may be about many currencies becoming digitally interoperable. The dollar, the euro, the yuan, stablecoins, CBDCs, tokenized assets, and potentially neutral digital bridge assets. If that architecture develops, the companies and protocols capable of connecting those systems could become extraordinarily important. XRP is one of the assets positioned directly inside that conversation. Whether it ultimately succeeds is still unknown. But the thesis is no longer simply, will XRP go up? The bigger question is, what happens to global money when the world no longer wants or needs every transaction to pass through one dominant monetary system? And if the answer is a more multipolar, programmable, interoperable financial network, then XRP's role becomes much more interesting. Not because somebody promised it would happen, not because a conspiracy has been proven, not because the underlying problem is real. The global financial system is changing. Short-term noise, long-term structure. Prices reacting, systems evolving. And if you want to understand XRP, don't just watch the chart. Watch the architecture. Watch the regulators. Watch the central banks. Watch stablecoins. Watch tokenization. And most importantly, watch how the world decides to move value from one financial system to another. Because that may ultimately tell us far more about XRP's future than a short-term price target could ever. If you've enjoyed this deep dive, make sure you subscribe to the channel. Hit the notification bell and let me know in the comments. Do you think the future monetary system will remain dollar-dominated, or are we moving towards a multipolar system where a neutral bridge asset becomes increasingly important? Hope everyone's having a blessed weekend. I want to welcome all the new members of our Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. What a wild ride this has been. I'm going to break down right here, right now, what I discuss with the people that retain us any capacity. It's not financial advice, but I'm going to say I got very, very good interpreting bank reports, and I learned from the best on the floor of the New York Mercantile Exchange starting at 15 years old. Being a financial mercenary, once our core thesis is proven correct, we move on to further downstream about what our whole wrecking thesis, how it affects everything so we can capitalize on everything happening at once. I want you to understand something. I really enjoy Goldman Sachs, Citibank, JP Morgan, and Deutsche Banks, and certain Chinese and financial institutions out of Asia and Japan's research. I find them fascinating and very, very good. And I like what Goldman is saying, where the commodity market is going. It kind of agrees with some of our thesis. I also like what DB has saying it's going. There's a lot happening underneath the surface of the commodities market right now, ladies and gentlemen. And it's a fascinating when you look at where the money is moving, where supply is tightening, and where positioning is getting dangerously crowded. Why I want to go over this right now, and this is a few minutes, is because the whole world now is FOMOing on things, right? FOMO becomes exit liquidity, ladies and gentlemen. It does. But the analysis of the commodities markets, I'm going to go over right now and pulling out what I've felt is important from certain banks, how they see it ties in together our core thesis when we said a week ago that every government was broke, but people still need to consume things. See, when you put all of this together, I think there's a much bigger macro story developing, ladies and gentlemen, because you got gold being accumulated. You got Dr. Copper dealing with physical tightness. You got European natural gas and diesel being driven by geopolitical risk. You got coffee and cocoa dealing with supply constraints. And at that exact same time, you got crude oil potentially running into a positioning problem. So let's start with the one thing that I think matters the most, gold. According to Goldman Sachs, they're seeing steady buying from both China and Western macro investors. And that buying is actually accelerated after the Treasury buyback announcement. And that's the most important because the buyback isn't itself enormous. The biggest story is the signal. The Treasury is telling the market that it's willing to become more active and manage the long-term end. But according to Goldman, they say the more lasting implication could actually be for the dollar and gold rather than rates itself. Think about this for a second, ladies and gentlemen. What that means, okay? If the Treasury becomes more proactive, investors start worrying about the future purchasing power of the dollar. Gold becomes one of the natural release valves, okay? According to Goldman, they're seeing real money move into this trade. They're seeing a combination of a 3 to 6 month gold structures and outright buying targeting 4,800 to 5,500 an ounce, not financial advice whatsoever, ladies and gentlemen. And this week also produced the second highest gold ETF inward flows for the SPDR and iShares. So you got China, you got Western macro funds, you got ETFs, you got central banks, you got commodity trading advisors starting to add length. So they're estimating central banks have bought approximately 57 tons of gold in June, which on a 3-month seasonality adjustment basis works out roughly to 100 tons per month. That's so huge because before 2022, the average is only around 17 tons per month. So think about the difference. That's a massive structural change. And China's a huge part of it. So Goldman estimates China accounted for around 40 tons of that buying in June. And then Goldman gives us a number that everybody needs to know, 4,900 an ounce by the end of 2026. That is their official forecast. But here's where it gets really, really interesting and perplexing to me, okay, when I read through everything. See, their flow, they're seeing already targeting 4,800 to 5,500. But if there's a case for 4,900 base case target, while investors are positioning for a potential move towards 5,500, that means, according to them, the risk is to a forecast remain to the upside because gold still represents a relatively small percentage of private portfolios. This matters to crypto because they're moving in tandem, Bitcoin and gold right now, which is very important to pay attention to this correlation. That's why if you look at the pullback, what happened right now in the crypto market, Bitcoin's still staying solid. The other coins have dropped. But if you look at this diversification story, eventually moves beyond central banks and into pension funds, institutions, family offices, private investors. See, the demand could become substantially larger. Now, if we compare that with crude oil, Goldman's actually taking a very different position here. They are viewing this as commodity traders are already at a maximum long in crude. If you look at them, CTAs and other funds are almost maximum long. And that means that the systematic buying that's helped push oil higher could start fading. That is so important. I cannot believe I'm giving this away for free. If you're writing this down, what I'm talking about, you really have a roadmap and the rules of the road. Ladies and gentlemen, if you want to be able to position from what I'm talking about and you want to learn to trade, you want to learn to invest, come and join the Crypto Public Desk Monthly. Come and join over 680 active traders, investors who are taking their financial destiny into their own hand. See the deeper macro research. Learn to position before the move. One trade, one tip from the bit can pay for your entire year subscription, and you get access to our 4 weekly Zoom meetings and monthly Zoom meetings, ladies and gentlemen. It's up to you. You can see how I present this. Capitalizing, taking advantage of this is the most liberating experience. But why this is important, and I think their specific trade idea is fascinating. They're looking at a November 2026 Brent $75 per barrel digital put, with Brent referenced around 92 and 60, and the option offered at roughly 9.5%. This is not financial advice. That's what they think is attractive. Not financial advice, what they think attractive. That's an institutional trade option. That's what they do. That's an institutional trade option. I'm not telling anybody to copy that, but the message behind it is extremely important. Goldman's looking at Brent approaching the July highs while volatility remains depressed and physical indicators don't currently suggest the market is desperately short of supply. So you got price pushing higher, but you've got volatility relatively cheap, and you've got systematic positioning getting crowded. Goldman's trade is essentially saying, what if Brent falls from 92.60 towards 75? That's the downside level they're expressing through the digital put. And Goldman expects commodity trading advisors to buy the flow to ease in the coming days. So if you got a fascinating divergence, Goldman's comfortable staying long gold while simultaneously positioning for downside risk in crude. If you look at copper, the bank simply doesn't want to chase the outright copper price. Instead, they like owning copper forwards and spreads because they continue to see physical tightness. We saw around 2,000 tons delivered in the LME warehouses, which temporarily relieved some of the front-end pressure. But Goldman says the underlying driven remains the COMEX LME arbitrage. And if that arbitrage becomes attractive again, copper gets pulled towards the United States, potentially tightening supply everywhere else. There's no formal flat price target here with this. So their trade is the spread and the forward curve, positioning for renewed front-end tightness rather than simply betting on a particular copper price. Then you got European natural gas. According to the Goldman, they see TTF gas has outperformed expectations. They were waiting for a dip to re-engage. That dip hasn't happened. Instead, geopolitical risk and tightening fundamentals continue supporting prices. So their desk is long European natural gas in a small size while macro interest continues increasing. Ladies and gentlemen, I like following mostly what Goldman and Citi have to say when it comes to commodity markets because they're retail-based. They're institutional-based. They don't really deal with retail. They don't. Citi doesn't deal with it at all. But when you see how they're positioning and why, it's massive. So they expect crude to come down. If that happens, that's going to be a bazooka bonanza for the crypto and gold. Oh my God. And they look at a 65 euro per megawatt hour as an important price level in their discussion. See, there's no formal upside price targets for that. But their thesis and our thesis is if geopolitical situation continues deteriorating and fundamentals remain tight, the market may not give investors the dip they're waiting for. And that's the most important piece of this entire my thesis right here, what I'm going over. You understand me? We're going to see the allocation of capital come out of certain trade. The whole thing has been fueled by oil and crude. And if their play and what other people are following is correct and what we think is well correct, and that drops from there, you're going to see certain markets take off so hard. It's going to be ridiculous because I always tell you, you got to follow the institutional money, the flows. They're weekly. They're quarterly, they're monthly nuts. And this is it, ladies and gentlemen. This is the most exciting part of a financial mercenary. You look at European diesel, that's about the inflation I think is important. You have a lot of global run refineries. They're down roughly 7 million barrels per day year over year. So if you think about it, at the same time, refinery margins are near record highs. That's an enormous divergence. Why? Refinery outages caused by drone and missile strikes in the Middle East and Russia. You got China's product export restrictions also weighing on refinery runs. Elevated crude prices are discouraging refinery buying in countries where fuel prices were heavily regulated. Who in their right mind would build a refinery right now that you could get hit with a $50,000 one-way drone? You just wouldn't. So think about that. There's a refinery capacity problem everywhere. You got Russia buying stuff. So you got European diesel deferred has already risen 30% since they recommended as a geopolitical hedge. Goldman was very big on this. They're very cautious with certain things. They're very, very cautious. They recommended that as a geopolitical hedge in late July. This is where I think it gets crazy. See, they estimate another 50 to 60% upside could be possible if refinery outages persist. So think about that. You're potentially looking at a trade that has already moved 30%. And according to Goldman, that trade could move up another 50 to 60% upside, could occur under a persistent outage scenario. This is why I keep saying the energy story isn't simply about crude oil, ladies and gentlemen. The real vulnerability could be refined products, diesel, jet fuel, gasoline, the stuff that global economies actually run on. See, if refined capacity remains impaired, the flows directly into transportation costs, manufacturing costs, architecture, agriculture, logistics. I'm going to get how this all applies to XRP in 1 minute. Stay with me, because I needed to set the table before I loop all this in. See, ultimately, inflation. Now let's move it to U.S. natural gas. Strong term support, record power burn, and significant salt storage draws. South Central cooling degrees says running around 16% above the 10-year average, and August power burn could hit a record around 51 billion cubic feet per day. There's a catch. Production. Production just hit a weekly record of 111.8 billion cubic feet per day. So you got strong term near demand, but you also got enormous supply. That's why Goldman expects winter in 2027 contracts to remain under pressure, even while the near-term market stays tight. I'm trying to take the PhD out of PhD. Every one of you still here, drop questions about what I'm saying and subscribe to the channel. There's not a specific Goldman price target or city price target here, but the key trade is the October to January spread, which according to Goldman expects to continue tightening. Now let's talk about coffee, because everyone likes that. There's another physical supply story here. The market needs to find a price level that actually incentivizes Brazilian producers to release more coffee. Nearby spreads continue to reflect tight delivered supply, and the December 2026 contract has repeatedly run into resistance around 320, but is broken now above that level. And this is the key piece that Goldman City, we're watching as well. A sustained mover above 320 could encourage more producers selling and potentially ease some of the tightness. But again, there's no formal price target here. It's just trying to get over a level. So the key number to watch here is 320. Write that down. And then there's my favorite chocolate, cocoa. This is a particularly interesting one because the bullish case is generated around the slow start to the 2026-2027 Ivory Coast main crop. They expect, and why they expect on the streets, October, November arrivals to trail last year. And the crop still has to navigate the upcoming mini dry season. You got tight West African supply. You got chocolate manufacturers continuing to buy price dips to secure the 2027 requirements. And you got Cote d'Ivoire and Ghana have already sold a large portion of their upcoming production. So available supply is limited. Here's the nuance. Nobody's particularly permanently cocoa bullish. Okay, not Goldman, not Citi, not DB. Longer term, they see a possibility of the market becoming more bearish if Cote d'Ivoire and Ghana become additional mid-crop production. The market manufacturers finish the 2027 requirements. They don't give a specific cocoa price targeted, but the trade here is about the physical supply. Bullish near term, with the possibility of a bearish transition once supply increases and industry demand is satisfied. Now, ladies and gentlemen, what this is saying, nothing, what this means in English, I'm going to take the PhD or PhD and why XRP crypto matters so much. And if you're still here, I salute you. Our videos are getting longer because I want everyone who is part of our wolf pack, our channel, our Patreon, to see how we see how the financial mercenary sees this, to understand this. This is very important. See, everything is, I'm not saying everything is going up. There's distinguishing between different forces. You got gold. Goldman has a 4,900 end of 2026 target, while market flows are targeting 4,800 to 5,500. They're conservative. They're not going to move their benchmark. They're very conservative. You got Brent. Goldman is expressing downside risk through a 75 per barrel digital put against the reference price of approximately 92.60. Copper. They like forwards and spreads targeting continued front-end physical tightness rather than giving a specific flat price target. European natural gas. They're long with a 65 MWH, an important reference level, but without a formal upside target. European diesel already up 30%. Goldman and Citi are expecting another 50 to 60% upside if refinery outages persist. Coffee. Goldman's watching the 33.20 level. So we, so is Citi on December 2026. Coffee is a key technical producer response level. Chocolate, my favorite trade always. Bullish near term because of West African supply constraints, but with the potential for a more bearish setup later as additional crop become to market and manufacturing coverage. The distinction is incredibly important because underneath all of these commodities, we're seeing three forces collide: positioning, physical supply, and geopolitics. And then sitting above all this is the treasury market, the dollar, global liquidity. That is why gold is the commodity I keep coming back to, because people just keep buying it. They're just buying it. They're seeing China buy it. Central banks are buying it. Western macro funds are buying it. ETFs receive cash flow. CTA started adding length. Investors are targeting 4,800 to 5,500. So if Goldman 4,900, what they're saying by the end of 2026, the risks to the forecast remain higher. It can go higher. So now you connect that to the Treasury story, and the Treasury is becoming more active. The long end is under pressure. The dollar potentially becomes the release valve, and gold becomes one of the biggest beneficiaries. If that eventually escalates into more aggressive intervention, the dollar weakens, if liquidity returns, if central banks keep diversifying, and if private investors finally start increasing their gold allocation, I don't think the question is simply, can gold hit 4,900? The question becomes, what happens if 4,900 is just the next milestone? And that's the big thing while people targeting 5,500. So, ladies and gentlemen, when you look at all of these things, this is telling such a story. Now, ladies and gentlemen, I try to take the PhD and a PhD for this. And I want you to understand this is not financial advice, just my own opinion. And anyone takes any capacity. And this is according to different banks on the street. This is not financial advice. This is what they're looking to position for institutional money. If they think energy goes down, if energy goes down right now, the markets will rally. Money will flow into risk assets. If gold goes higher, expect Bitcoin, as far as we're concerned, will move higher with it. That will drag up the rest of the cryptocurrency market. We always follow coffee, chocolate, copper, gold, and the treasury. To us, those are the story about inflation, supply chain, geopolitics, the dollar, treasury markets, everything. And if you understand where the next major moves in the financial markets come from, you're getting ahead, ladies and gentlemen. So what did we see this week? We saw a reversal of a lot of things. If they're right, if the big institutions on the street are right, and I tend to think they are, crude is going to come down. The refining and gasoline products have to go higher because there's no refinery capacity anywhere. There's not, and they're being taken out in the military conflicts around the world. I think gold is going to move much higher. I think Bitcoin is going to move much higher. We're positioning for it. We think XRP is going to move much higher. Ladies and gentlemen, I'm trying to outlay something that the most important part of where we're going in the future is the digitalization of everything. These commodities as outlaid here, we'll wind this, transcribe this, write this down, come to join the Crypto Public Desk monthly, see how we're going to have transactions and plays with exact stop losses, take profits, everything for this around these levels and equities around these markets to take advantage of. Being a financial mercenary is a decision. It's a choice that you're tired of seeing everyone else around you get ahead and you want to get ahead on your own and you don't need to be part of some fancy bank or hedge fund or anything like that. Someone has to just teach you and there you go. I'm excited for where we're going. This video was a bit longer. I'm sorry for that. But I want everyone to understand that there's physical constraints in all the commodities I just spoke about. I mean, I pay attention to these whacked, weird little factoids that no one else does because that's all I do is read, working 7 days a week in the office about this. When you're financial mercenaries, and why say there were more? We're swimming underneath the apex predators, feasting on the sushi. FOMO is the exit liquidity for almost everybody. So ask yourself this question. As life breathes back into the market and they're going to buy more treasuries and we believe crude will come down, we're seeing financial positioning for that. We see the financial positioning where copper tells a story. All these tell a story, ladies and gentlemen. XRP is going to go higher. That is our opinion. It's not financial advice. We believe XRP goes higher. ICP will go higher. HBAR will go higher. It will be dragged up by the speculation through gold and the speculation in Bitcoin. Rising tides raises all ships, ladies and gentlemen. Don't FOMO this. Don't get caught up like sushi here. Gucci conviction, Gucci clarity along the way. Ladies and gentlemen, it's time to set sail and lose sight of shore. When we hoist the mainsail here and we harness the winds of the volatility, that is what we've been waiting for. Have no fear. Keep the Gucci conviction, the Gucci clarity. What I just outlaid here is part 3 to my rant that we said before all this happened. And if you're a subscriber to this channel, you heard it first before anything else. We're not YouTube influencers, ladies and gentlemen. We're financial mercenaries. If you want to really take advantage of being a financial mercenary, come to join the Crypto Public Desk monthly, ladies and gentlemen, and take advantage of all the tips from the pits. But let me tell you this right now. We don't got to really, in my opinion, we got to watch September 15th to October 6th. That's what we have to watch with the narrative right now. And this affects XRP, XLM, ICP, HBAR. The narrative right now, the wind is in the mainsail. We're going, we're moving. The pack is hunting. When those dates come back, that will change things. But again, I'm going to riddle me this Batman. Does Congress want POTUS and his selected administration officials in different agencies to write the rules of the road, or do they want to write the rules of the road through the Clarity Act? Ask yourself, do they come back and vote on this 1, 2, 3, yay, so that he doesn't have to write the rules or want to write the rules himself? That's a distinction question right now. I love you all, ladies and gentlemen. I'm going to see you on the front line. This video is for educational, entertainment purposes only. It's not financial advice. Always consult a licensed financial advisor before making any investment decisions. Never invest a single dollar based on watching a YouTube video. For everybody in the Cryptoholic Desk Monthly, I'll see you tomorrow at 2 p.m. Eastern Standard Time. I love you all. I'm going to see you on the front lines, as always.